Hello, everybody, and welcome back. Today, my guest is Jonathan Butler. Jonathan is the head of European Leverage Finance and co-head of Global Leverage Finance at the US asset management company PGIM. And today, we want to discuss recent developments in the European fixed income market. Welcome, Jonathan.
Thank you. Glad to be here.
Jonathan, the ECB has taken a more restrained stance on rate hikes in comparison to the Federal Reserve. So why should investors consider Euro high yield bonds over US high yield credit right now?
I think there's been a couple of changes this year in sort of the economy globally. And obviously interest rates has been a very important factor, but you've also seen a systemic change in the European economy led by the energy crisis from the Russia-Ukraine war. So we've seen European credit spreads underperform the US by a material amount. And obviously we've seen all bond markets sell off because of interest rate risks, but we're seeing a very different path around interest rates between the US and Europe. So we're obviously led by the US and seeing the large rate rises in the US, but that's coming from a really strong US economy. Whereas actually Europe, we're seeing rates rising recently very quickly, but we actually believe the European economy is actually heading towards a recession. So with the rate rises that we've been having sort of in the second half of this year and likely to continue into the near term, we actually see that pausing next year as Europe is likely to be in recession. We actually think it is already in Q4, and those numbers will come out soon. So we may be hitting peak rates in Europe fairly soon, while credit spreads in Europe are actually quite attractive. So if you're a European investor and you're looking to invest into high yield generally, and you're hedging back to euros, you'll find that the overall returns you'll get from euro high yield are much higher than if you're hedging your dollar high yield portfolio back to euros. So the other addition you get is it's a higher quality index. So we think you're taking lower risk for higher returns over the medium to long term.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now.
So you already mentioned some of the influencing factors. How do problems with Russian gas supply, rising inflation, and the lower growth expectations match with the attractiveness of European high yields currently?
So the constructive part is that obviously yields have increased a lot. They're more than double where they were at the start of the year. And so the yields in European high yield now are the highest they've been for more or less 10 years outside of crisis periods. So I think that the entry point is a lot more attractive. Clearly, we are facing a recession. Consumer confidence is at record lows. So we actually think in the near term, there is likely to be spread widening and that these yields actually have to go even wider because of what we're facing in terms of a economic shock and a systemic shock to Europe. So the gas was switched off. I mean, now there have been explosions in some of the key pipelines, so it can't even be switched back on again. And that is going to change the European energy infrastructure. And obviously, Europe has to contend with this, and that will take time. The start of the energy shock was really sort of in February, end of February this year. But energy prices, if you recall, were actually already very high going into the end of 2021 and in the lead up to the war this year as well. So we were already suffering from high energy prices. We've now had over 9 months of the Russia-Ukraine war. So we're actually closing in to the 12-month anniversary of these really high energy prices, which means that energy price inflation is actually going to start to stop because we're almost at a full year of very high levels. And actually, if we do go into recession, typically you would see energy prices fall as demand is destroyed. So I think we're probably through the worst of the energy price rises, but clearly there are knock-on effects to inflation. But those shocks are working their way through the European economy. We're already in a cost of living crisis for Europe. The inflation that we're seeing in Europe is largely imported. It's energy inflation, it's obviously fuel, transportation. goes into food. So the food inflation that we're seeing is really a translation of energy costs, also shortages of certain products. But most of these things are going to come through on a sort of 12-month basis very soon, which will start to diminish European inflation really from March next year. So we expect to see European inflation starting to come down.
So we have seen this incredible strong US dollar. So what is the impact of the US dollar rally for European fixed income market? And what is your outlook for the US dollar euro couple?
I think the US dollar is obviously strong, driven by the rise of US interest rates. And also Europe is facing a systemic shock because of the Russia-Ukraine war. So it doesn't shock us that we've seen the dollar do so well. I don't think the euro is doing particularly poorly. I think it's more dollar strength rather than anything else. But what does that mean for Europe? I think it means that we'll probably see more US tourists. And I think it's probably ultimately good for European exports that there's a weaker euro. But I think it's really about dollar strength is what we've been seeing.
So you mentioned that eventually the worst is already over for the European economy. So do you expect?
No, I haven't said that. I've been saying that the worst is near. What I'm saying is the worst in terms of bad news is near. So the European economy I see is in recession next year. Our house view is that the Eurozone has a negative 1.4% GDP. So we're actually quite pessimistic for next year. But I think the bad news is out there some point soon. So the markets will predict sort of how bad the economy is. And I think when the markets react to what we believe we're going to see in terms of economic data and in terms of corporate earnings in Q4 of this year, which may take until January, February before all of that is there, we see between now and then that there should be a period of spread widening. At that point, we think it then becomes an interesting entry point into high yield.
What are your expectations for the default rates in Europe, and how do you protect your portfolios against rising default rates in the near future?
So default rates have been extremely low this year. If you look at Western Europe, so ignore issuers exposed to Russia, Ukraine, the Western European default rate is actually only about 0.5%. So it's at very low levels. The issue is going forwards, clearly we're not going to stay at record low default rates forever, especially in this environment. So obviously we see them rising. Our house view is that we'll see somewhere between 2 and 3% default rates next year, which is relatively low compared to some other estimates. The main driver of that is that most companies were able to refinance last year. And so therefore there's no near-term refinancing needs. The corporate earnings through this year have actually been quite reasonable. So at the start of the Russia-Ukraine war, as we were coming out of COVID, we were still seeing effectively a reopening trade going on in the economy as people were getting busier and doing more. And through the summer, the consumer wanted to have a summer holiday, having not been on holiday for the last few years. So the economy has had a fair amount of momentum through 2022. And we think that that is now stalling as we face this cost of living crisis and the energy crisis. So really hard for companies to default next year because they have liquidity. Also, if you look at the quality of the European high yield market, 70% of it is double B. So the balance sheet of the European high yield market is actually in one of the strongest starting points in a recession that we've ever seen. And so again, to sort of see all of these companies default is relatively unlikely. And the sort of key drivers of default is usually running out of cash, and that often happens on a refinancing date. Because these refinancing dates are spread over the next sort of 5 to 7 years, while there are companies that will have challenges next year, and we will start to see zombie companies, the overall default rate, we don't see spiking to materially high levels over the coming economic period. But we do see a sort of a higher plateau over the next 5 years of a 3% plus default rate, but being slightly lower in 2023 than where we end up in 24, 25, maybe 26.
What are the first investment opportunities that come to your mind? What industries and companies are preferred by you and your team? And what yield opportunities do European high yield bonds currently offer compared to investment grade?
We will rotate our portfolio depending on the investment environment. So with our near-term concerns around the economy, we're fairly defensively positioned. I mean, this is a great time for being an active manager. So where I say defensive, we're concerned about spread widening, we're concerned about decompression. So therefore, we're looking for defensive industrial sectors and at the same time also generally higher quality. So we typically run an overweight to European single Bs. We've been reducing that overweight and we've been buying more double B issuers and also in defensive sectors. So defensive sectors, I mean, so telcos and cable, where we see sustained demand. And obviously at the other end of the spectrum, consumer discretionary. So things, the luxuries that we don't need to buy when we've got a cost of living crisis, those sorts of businesses we expect to obviously suffer disproportionately more. So we've rotated our portfolio into parts of the index that we think will have less economic shock as we go into recession. Now, if spreads do widen and our default predictions sort of prove to be valid, there will be a point where we'll pivot into some more cyclical sectors, and we'll obviously rotate the portfolio as we go into the recession and we understand more around the depth and the length of that recession. There'll be a time where we'll be wanting to take more risk. But there'll be companies that have earnings shocks. We expect to see those businesses get punished in terms of their credit spreads and their bond prices. And so we're expecting to see a fairly volatile time coming forwards in the next few quarters.
So the issuance of high yield credit has declined in Europe with rising spreads. So what are you expecting for the market near term, and how can an investor capitalize on this trend?
In the near term, I mean, again, I think it's a time to be somewhat defensive. So we actually prefer IG to high yield right now. And I think that's really that we see the wide IG spreads and maybe away from the real estate sector. We're expecting to see this decompression trade. And so therefore we kind of believe that high yield will suffer relative to investment grade in the near term. But with yields where they've got to, we do think that we're getting towards an environment that will be very interesting for people investing in high yield. And that could come as soon as sort of before year end, but we would expect it to be coming in Q1 next year.
You already said you're quite pessimistic for the next year for Europe. So where's the light of the end of the tunnel? When can Europe come back to growth mode? And when will it be time to put risk on mode again?
Yeah, well, I mean, I think we have to think about why is Europe going into recession, and I think that has come from a systemic shock. We have a lack of energy supply. Germany's lost 40% of its gas supply, and obviously that needs to be replaced. And unfortunately, that is creating the supply shock to energy. It's creating the spike in energy prices, and that is that supply shock to the economy which is causing this recession. So it's not something that has been sort of Europe living to excess. So it's not what we're seeing from what happened pre the financial crisis. It's not the same as COVID. This is a different rationale or different reasons for the recession. But it's obviously an energy transition that we're having to deal with, where we have to tighten our belts and put some jumpers and hats on to get through the near term. But I think Europe will come through this, and with the passage of time, and we've already had time to work on this, there will be an energy transition. So we will find new sources of gas. We will find new types of energy, whether it's more renewables, and Europe has the ability to grow strongly out of this. But we're having to cope near term with the shock, and that takes some time to transition. So we're not even into that shock yet. We've had a really mild autumn, so we haven't been using the level of gas that one would expect. And as Europe gets colder, and we're seeing that day by day now, obviously we'll start getting through some of those energy reserves. and the energy reserves will start running down through January, February next year. And obviously we need to replenish those for winter 23. So we've got some hard work to do, but the markets obviously look forwards from that, with that. So where the market's trough is not the trough of the economic pain, the markets will start to read through where the growth is going to come from. So we've got to adjust to where things are, and 2023 will be the sort of period of economic adjustment, and then hopefully we'll continue to grow beyond that. And obviously the inflation pain that we're suffering right now, I think will start to subside as we see stabilization in energy prices and stabilization in food prices. And what we're not really seeing in Europe compared to the US is wage inflation. So in the US, the job market is on fire, and that's what's really then having to drive US interest rates, whereas Europe's in a different position to where the US is. So I don't think that Europe follows the US on the same interest rate curve.
So this was Jonathan Butler from PGIM. Thank you very much for being with us today, Jonathan, and for your time and your insight.
Thank you very much.